I'm Juan Castillo,
And I am Carson Melom-Lemos.
and this is case one, and we did Verizon and AT&T. Who are the shareholders? Shareholders are contributors or owners of the company who contribute for the finances. AT&T has 7,391,000 shares outstanding. Shareholders including Vanguard, BlackRock, State Street Corp, and others. Verizon had 4,141,000 shares outstanding. And there's top shareholders including Vanguard as well, BlackRock, State Street Corp, and Wellington. So why do investors care about cost of capital? Cost of capital represents cost of equity in addition to cost of debt. So this way, investors see if the company is being used to the max potential. And if everything is done right, then this relates to higher returns for the investors. Cost of debt financing. We found that AT&T has bond ratings of BBB, and with the formula of short term plus long term divided by stockholders' equity, we got a number of 1. As in regards to Verizon, their buy rating is BBB plus. With the same formula, we got 2.17 for them. Cost of equity, we use CAPM. So CAPM is basically what the investment is required for the return. So the risk-free is a 10-year bond, which we found on Yahoo Finance. On February 10th, it was 1.547%. The beta for AT&T was 6.29. As for Verizon, for that day, it was 0.510. The market premium historically has been between 3.5% to 5.5%, but we used the average of 4.5%. After we did the formulas, AT&T CAPM was 3.41%. Verizon was 3.76%. As for the cost of capital, they look at it to expand or reinvest or build structure. The formula shown in the slide for AT&T, in comparison to WACC, we got the return on capital was greater than WACC, so it's stable. Verizon, we found the same solution as well, so both companies are operating in a less financial burden.
Changing capital structure. AT&T and Verizon both have a higher equity to debt capital structure. According to our analysis on debt to equity, both companies should lower their debt by 6 to 10% to reach the optimal range. This would lower risk associated with each company by decreasing leverage from creditors. Value per share would also increase in both companies to give shareholders more profit and reasons to own shares in the company. Financial restructuring of both companies to decrease debt would create a net gain for both and ultimately increase the company's value, as seen in the slide. This increase in equity over debt would give investors a higher return on investments with an increase in dividend payouts, usually. Now, more debt would be an unnecessary risk for both companies. So reducing debt from their capital structure is the optimal range, and an increase in debt could put their business assets at risk by agreeing to provide them as collateral. Potential investors might also see an increase in debt as a high risk investment, especially if the bond rating is lowered because of this. Another way that increasing debt would create more risk is that it could put a burden on cash flows, and if funds aren't used properly, it could be difficult to repay. Now, we both compared AT&T and Verizon to T-Mobile with return on assets and return on equity. All three of these companies are higher equity firms, and we found that Verizon surpasses both companies in each respective category shown here on the slides, meaning that they are more profitable on the usage of their assets and investments. Now, according to our analysis, also AT&T and Verizon have a fairly valued current stock price. Verizon's stock price is higher than AT&T, and we found this to be fair because Verizon beat AT&T in 4 out of the 5 valuation methods we used shown here in the chart. And in conclusion, we have found that Verizon is a better investment after reviewing our valuation methods for each company. Verizon also has a beta of 0.43, meaning it is less riskier than the market. And thank you for listening to our presentation.